Welcome to this explainer. If you've been tracking the commodities sector lately, you know we're right in the middle of something truly historic. But to figure out what's really happening beneath all those flashy headlines, we have to dig into the raw data together. Today, we're breaking down the latest Q2 2026 results from Newmont, Aura Minerals, Centerra Gold, Galiano Gold, and London Gold. We'll explore the massive macroeconomic tailwinds, exactly how that cash is being spent, and the very real, very gritty operational hurdles these companies are still battling every single day.
Let's kick things off with this mind-blowing number right here, $2.2 billion. That is the net income Newmont Corporation pulled in during just the second quarter of 2026. Honestly, when I first saw that, I had to rub my eyes and check the math. Over $2 billion in pure profit in a single 3-month window. We're starting here because it immediately sets the scale of this current mining boom. This isn't just some slight market uptick. This is an absolute tidal wave of capital flooding into the industry right now.
Okay, so here's our roadmap for today. First, we'll hit the 2026 gold rush. Then we'll look at record profits and revenues, followed by rewarding the shareholders, reinvesting in future growth, and finally, we'll get into the dirt with ground-level operational realities.
Let's start with Section 1, the 2026 gold rush and the macro boom.
We absolutely have to start with the massive macro tailwind, lifting everyone's boats, astronomical precious metal prices. Just look at these realized gold prices for Q2. Aura Minerals hit $4,304 an ounce, London Gold, $4,359, and Galiano Gold topped out at a staggering $4,432 per ounce. Seeing operators consistently pull in over $4,300 an ounce is just wild compared to historical averages. It sets the stage for historic cash flows because every single dollar above their sustaining costs is just pure, unadulterated margin.
Moving right along to Section 2, record profits and revenues, and the financial windfall.
Let's look at how those sky-high prices are hitting the bottom line. Aura Minerals is a perfect example of this leverage at work. Their Q2 net income was $217.7 million. That is a jaw-dropping 2,572% increase year over year, which pushed their core operational profit, their adjusted EBITDA, to $802 million. Now, sure, part of that huge jump came from paper gains on price protection contracts, but even if we just look at their adjusted everyday net income, it still sat at over $97 million, up 164%. The sheer financial velocity we're seeing here is incredible. And here's a side-by-side that really puts the physical volume driving these profits into perspective. London processed over 500,000 tons of ore, produced nearly 119,000 ounces, and sold over 110,000. Because of those wild realized prices we just talked about, they pulled in $478 million in revenue in one single quarter. Galiano, meanwhile, produced over 34,000 ounces and sold roughly 35,000. Just think about the logistical feat of mining, milling, and processing all that rock safely while raking in this kind of cash. It proves the industry is literally operating at peak capacity.
Which naturally leads us to the biggest question for any retail investor tracking these markets. What on earth do you do with all this cash?
That brings us to Section 3, rewarding the shareholders through capital allocation strategies. Basically, management teams are aggressively funneling capital back into your pockets. Look at London Gold. They dropped a staggering $293 million in Q2 dividends alone and still kept over $500 million in the bank. Aura Minerals just greenlit a program to buy back up to $200 million of their stock, maintaining a 4.3% yield over the last year. And Centerra Gold, they've bought back over 28 million shares so far. The message is loud and clear. Companies want shareholders to feel the direct, oversized benefits of this supercycle right now.
Next up is Section 4, reinvesting in future growth and securing the next decade.
Because, the smart money fixes the roof while the sun is shining. You can't just hand out all the cash. You've got to deploy capital to secure tomorrow's production. Take Centerra Gold. They dropped $51.6 million in non-sustaining capital this quarter to restart their Thompson Creek mine in Idaho by mid-2027. They're capitalizing on the massive demand for strategic metals like molybdenum, which is absolutely critical for aerospace and defense. They're literally using today's gold windfall to buy tomorrow's strategic revenue streams.
Meanwhile, Aura is pushing forward with their Era Dorada project down in Guatemala. And this isn't just your grandfather's mine. It's about building a modern, sustainable footprint. Earth moving is already 60% done, but the really cool part is they're building a closed water circuit that reuses 100% of the processed water. Plus, the whole site will run on a fully licensed geothermal energy source that Aura actually owns. They're using current cash flows to set a totally new standard for ESG compliance in mining.
All right, final stop, Section 5, ground level operational realities and the gritty reality of the business. We have to bring this whole narrative back down to earth for a minute. It is so easy to look at pristine Wall Street balance sheets, record margins, and massive buybacks, and forget what this business actually entails. On the ground, operators are battling soaring all-in sustaining costs, mathematically brutal mine sequencing, and, well, the simple reality of broken heavy machinery.
Think about it. Despite all this high finance and $4,400 gold, a single busted gearbox on a ball mill can bring the whole operation to a screeching halt. Galliano Gold dealt with exactly this in Q2. They successfully mined 1.8 million tons of ore, but their mill availability got capped at 90%, simply because they had to stop everything to replace a failed gearbox. It's a stark reality check. Your pristine financial model is completely at the mercy of massive, grinding industrial gears.
Then there's the harsh reality of shifting operations. Check out Aura's Q2 all-in sustaining costs. If you exclude their MSG project, the company-wide average cost is a very solid $1,653 an ounce. But look at that second bar. The MSG mine reported a cost of almost $5,300 an ounce. Why? Because they're pouring massive investments into underground infrastructure to totally invert their mining method to a bottom-up approach. It's going to drive a huge production bump in 2027. But right now, management just has to grit their teeth and absorb that severe, localized cost spike. Which brings us to one final, really crucial thought. We've seen the unbelievable profits, the huge buybacks, the new sustainable tech, and the very real friction on the ground. But listen to this. Centerra's own 2026 sensitivities table shows that a mere $250 drop in gold prices could wipe out over $30 million in cash flows. The margins are incredible today, but the leverage definitely cuts both ways. So I have to ask you, is this record-breaking run the permanent foundation of a new mining era, or are we just standing on a fragile peak waiting for the wind to shift? Thanks for hanging out with me for this explainer, and definitely keep your eyes on those commodity charts.